All right, so welcome to the final stretch for preparing our general ledger accounts. So this is going to be part 4. So in this part 4, we're going to focus on preparing trade receivables control as well as trade payables control accounts. So you would expect to be tested on these things because they are very important. So we have covered the most important general ledger accounts. We covered the bank account. How do you prepare a bank account? That was part 1. Then we covered the capital account. And that was part 2. Right now we're covering trade receivables control and trade payables control in part 4. So part 3 we did cover the various accounts like that you have to, the way you record the various general ledger accounts based on transactions. But these ones are the most important. All right, the bank account, your capital account, trade receivables, and trade payables. So you must know how to construct those 4. Rosa, we're gonna focus now on the part 4. We're gonna focus on those 2 accounts, right? So we're gonna start with preparing the trade receivables control account, right, in the general ledger of GS Electricians. So the first thing that you need to know is you need to be able to define what is a trade receivables control account. So a trade receivables control account is a general ledger account that you use if you deliver a service or if you render a service or if you sell to a customer on credit. In other words, you do something for the customer, all right? The customer doesn't pay you immediately. So, but you need to record that. So you're gonna come and say debit trade receivables control plus the name of the customer, right? And you're going to credit sales, all right? So that's the initial transaction because it's either sales or services rendered depending on the nature of your service that you provide, right? But then now on the debit side, we're gonna debit trade receivables control. We're also gonna record the name of the customer because we wanna remember this guy. If we just because the trade receivables control is gives you the totals, right? So you won't be able to see who is who. You just have the total amount. But you also record separately under his name. You also debit this customer under the. So you have an account for the customer. Like if you use Edgar's, you know what Edgar's does? They do record what you owe in the trade receivables control, right? But they also record the same amount under your name so they can remember you, all right, your account. So whenever there is a credit transaction, you need to write down the name of the person and the amount as well so that you will remember that. But if it is a cash transaction like Pick and Pay, they never write down your name, right? Because you just give them the cash and that's it. If you go to Edgar's and buy on cash, they don't write your name down. Just that's it, they go. But whenever there is a credit, you need to remember the person and so you can complete the transaction later. So trade receivables is affected when we deliver to a customer and the customer doesn't pay, right? So whoever it is, but he doesn't pay us, we deliver something and then they don't pay. Then eventually when they pay, all right, so they could pay eventually, then which means that we're going to reduce the trade receivables. So it's a T account with a debit and a credit. If we provide a service or we deliver to a customer and the customer hasn't paid, we're gonna record all the amounts here, right? If the customer pays, it means it's reducing what he owes, then we're gonna record it here, right? So that's a customer payment. Or sometimes the customer doesn't pay, they return the goods to say your goods are broken. So returns means the customer owes us less, logically. So we record them on the credit as well, right? If we offer customer discount, right? So the discount will also reduce what the customer owes. It will be here. All right. Okay, so let's see how that we will eventually go to. If you're doing the course for financial accounting, like FAC1501 or FAC1502. Then we will reach a point where we have to deal with trade receivables and trade payables in greater detail. So this is more of an introduction. That's why we classify it under general ledger accounts. All right. I hope that does make sense to you. So what we're going to be doing when we read, because we know we need to prepare the trade receivables control, we need to see those things that increase what customers owe and those things that reduce what customers owe. So the first one, is we rendered services on credit. So we went to it's W right. So we charged W right 3,000, but this guy didn't pay immediately. So obviously that's a trade receivables control transaction. So we have to, because it's increasing, all right, we have to record this, and it is going to increase our trade receivables. All right, so it's going to be an asset. Trade receivables control is an asset. So this will be an entry on the debit side. Then this guy settled his account in part. So he just paid 1,000 rand. So we have to write that's 1,000 rand on the credit side as payment, right? But in this case, on the 31st, we rendered services for cash. Because we rendered services for cash, we're not going to record this in the trade receivables control. So for enrichment purposes, let us do the debit and credit on here, but then we later on go and prepare the trade receivables control. This is just for enrichment purposes. So when we rendered services on credit, we're gonna debit trade receivables. We're gonna credit services rendered, or sales if it was sales. Now this guy settled his account. He paid 1,000. So this came into our bank account. So we're gonna debit bank. We're gonna credit trade receivables to say the trade receivables have reduced by 1,000 rand. And now here we have services rendered for cash, 2,000. So this came into our bank account, and we also record services rendered. So you see that only 2 transactions there are going to affect the trade receivables control. Right, so so where do we go from here? So this is our trade receivables control. All right, so the services rendered, there's 3,000, remember. So we come and put it on the trade receivables. So the name will be somewhere here, trade receivables. Then we enter an amount of 3,000 on the debit side. Then this is the contra account. Services rendered was credited. Then on the 25th, we received this in the bank account. So the trade receivables again is affected. So we enter 1,000 rand on the credit, and we mentioned that the other account that was debited was bank. So now we have to balance that. And so the biggest side, this is 3,000, this is 1,000. All right. So the biggest side is 3,000. So the balancing side is the credit side, which is only 1,000. So the balancing figure is 2,000, and it's a balance carried down to the following month. So into the following month, it becomes a balance brought down of 2,000. So what we know is that by the end of March, we had an amount of 2,000 owing from customers. So we expect that to be paid in April. So we are keeping our records, right? So we can understand what happened. So when we are doing the double entry in a credit transaction, remember we have to say debit trade receivables, right? We also debit W rights account, right? And then we credit services rendered. Because W right is the guy who owes us. We need to remember. If we just record in the trade receivables control, we won't be able to have anything under this guy's account. So we also have a debit entry here, right? So always remember that whenever there is a transaction on credit, then the name of the person on his account, or on the person's account, or on the individual's account, we need to enter something. All right. Always remember that, because then you get a good marks for that. So next we go to trade payables control. So the trade payables control account is when we owe people for our operations. All right. So trade payables is not when we owe people who gave us a loan, like the bank, or like the bank overdraft. No, it's people who owe us for our on our day-to-day transactions, right? But not a loan. So on our operations, when we're buying and selling, we're doing our operations, we owe the municipality, we haven't paid City of Johannesburg, so that's would be in the trade payables control. We haven't paid the suppliers, right? Remember, that won't be, that suppliers in particular will be trade payables control. But sometimes it's a bit tricky because then I want to say there's also what is you refer to as accrued expenses. So in our operations, when people owe us, those accrued expenses are going to be recorded in an account called accrued expenses. All right, not necessarily under trade payables control, but you can also record them there because the principle is the same. Remember, the actual accounting, right, is done differently in companies. It's going to be done differently. All right. Some companies can put everything under their trade payables control. You have a setup like that because that's what you want. But then, according to the principle, it must be put under accrued expenses. If it is an owing because of just our operations like rent owing, salaries owing, electricity we haven't paid. But if it is owing because of the things that we buy for resale or for use, all right, but it's the distinction is a bit blurred at some point. All right, so I will say to you what we owe our suppliers is trade payables control. So we bought stationery on credit from VNA Stationers 1000. So if you want the debit and credit here, stationery, we bought stationery, right? So we're gonna debit stationery. We're gonna credit trade payables control, also the name of VNA in their own account. So we're gonna open a VNA account in what is referred to as a subsidiary ledger. All right. So in the subsidiary ledger, there is individual people's names, so their accounts, the individual accounts. All right, and we know who actually owes us how much, or who actually do we owe how much. Right. So we careful to distinguish between things that we buy on credit and things that we buy for cash. Only credit transactions will be recorded. Only things that affect the credit transactions. So we bought a voltage tester on credit. That's what we had. On credit or on account is the same thing, right? So we have an on credit or on account. So which means that this is a voltage tester. So it's not inventory. So we're gonna debit voltage tester out. That's equipment, right? We're going to say trade payables control, also the name of B suppliers. Then we made a direct payment for 500 into the bank account of BB suppliers. All right, I wanted to say these ones, right? Right, so we made a payment. So trade payables control is being reduced. The amount owing has been reduced by 500. Trade payables is a liability. Liabilities decrease on the debit and increase on the credit. So, and our bank account, we're gonna credit because money went out. So the balance is decreased. Brilliant. So remember that, all right, so that is where we are. So all transactions are going to affect trade payables. So the first transaction, we enter 1,000 Rand on the credit, and the description is stationary, right? Stationary, also VNA, but it's stationary. Then again here, 2,000 Rand on the credit, and equipment is the Conra account. Here we're gonna go on the debit side to reduce the liability, to say we have reduced it by 500, and the Conra account is the bank account. So if you come to your trade payables control, the first one is stationary, 1,000 Rand. This is the account that was debited. Then we bought equipment of 2,000 on credit, right? But then later on we did make a payment. So the bank account was credited, when we debited the trade payables control with 500, we credited the bank account. So the total for both sides is, this is 3,000 on the credit, this is 500 on the debit. So if we want to see which side is bigger, it's obviously the credit side. So the credit side provides the totals for both sides. Not the credit side, the biggest side. So 3,000, 3,000. Then the smaller side provides the balancing figure, which is referred to as the balance carried down at the end of the month. All right. So, and then it becomes a balance brought down here. So that's my typo there. It's a balance brought down, all right, into April. So I hope you can make a sense of these things, and you can always have this, you can keep on practicing over and over so that you're going to be happy people, right? Brilliant. Now we go to question 3. So question 3 is slightly interesting in the sense that, well, it gives us a little bit of detail, and then it requires us to complete the trade payables account. All right. So we're going to listen to the story, and then we're going to complete the trade payables account. So as we read, we want to know which side does this transaction go and what's happening. So we have opening balance is 14,145. Now trade payables is a liability that increases on the credit, so it will have a credit balance, right? Generally, so that's generalizing, that's rules, all right, but it can have a debit. But remember, everything that increases on the debit is assumed to have a debit balance. So if there's an opening balance on something that increases on the debit side, using the dead click, then if we have an opening balance, then we assume that it's on the debit. If we have a opening balance for something that increases on the credit side, the click, then we have an opening balance, then we assume it's a credit balance, unless specifically told. So this is a liability, has an opening balance. So if I'm going to open my account like that, then my balance would be here. At the beginning of the month, 1 January, balance brought down from the previous year. So this is going to be this amount. Right, then total purchases for 2023, for January 2023. So what I'm going to do is, I don't know whether they were on credit or cash. They just said total purchases. So what I want is credit purchases. Because if I get credit purchases, I'm going to record them on the credit side because we owed people as a result of that. Then cash payments journal, when we were making payments, we paid trade payables. The total that was paid to trade payables, right? The total is this amount. So out of the bank account, we paid this amount. But then those creditors, those creditors, our suppliers provided us with those goods on credit, but we returned some, right? So those things that we return are going to be on the debit side because they reduce what we owe. If we buy something from a customer and we return it to say that's not the size that we want, we no longer owe that. We have to cancel that. So what we owe decreases. So it's going to be on the debit side of the trade payables. But here we need to determine. So this is the cash payments. The payments that were made in the trade to suppliers is 37. So it's going to be on the debit. But here we need to determine how much was credit purchases, because here we are just given total purchases. And we are told that 50% were done on credit. So we know that 50% of that is going to be a credit entry, right, in the trade payables. So now our trade payables is going to be something like this, right? This is going to be opening balance on the credit, then total purchases, 50% on the credit, cash payments, debit, what we returned reduces what we owe. It's going to be a debit. So that will be 50%. Then the trade payables column in the cash payments journal were undercast by 490. Undercast means we were adding up, right? We make entries and maybe at the end we want the total that was paid to. And so when we are adding up, we make a mathematical error. So it was smaller. The amount was undercast when we're adding up. We missed a 490. So we have to add a 490 here, right? So that's the adjustment. Then on 10 January, this guy retained goods sold to him on credit to the amount of 674. So this transaction was recorded in the sales returns journal. So which means that it was wrongly recorded. We need to record it correctly. So this guy retained, what we recorded as retained is 5630, right? But we forgot to record this. In other words, we recorded it wrong. So we don't have this 674. It has to be added on here. I hope the things make sense. So now what has been done is we have these two amounts on the credit side, these two amounts plus the adjustments on the debit side, right? So we have the balance brought down that amount. Then this was sold on credit. Remember, it was 50% only. And we said, if we purchase, we're going to assume it's a perpetual inventory system. So we're going to use inventory here that was purchased, right? 50%. Then here when we paid, we forgot the 490. It was undercast. So we have to add it. And the contra account is bank because we made payments of 37746 in total, right? But we also retained 5630, which we recorded, plus the 674, which we forgot. So in total, we retained 6304. So our trade payables control was reduced by the payments, was also reduced by the returns. We started with a balance of this, and then we bought on credit for this. So now we need to know, so what's the balance? Because we have made entries on both sides, right? So we need to know at the end of the month, how much do we owe people? So that's the duty of accounting. You record transactions in the general ledger accounts, then you can check those accounts to see what happened. So now when you balance, you have to balance the accounts, right? We need to know which one is the bigger side. So this plus that is going to give me 14 plus, it's going to give me 74, all right? So it's already bigger. 37 plus 6 is going to give me 43, so it's smaller. So this side is going to provide the totals. So if you add that 14145, 14145 plus 60443, so I get 74588. All right, so I get 74588. Then on the debit side, I get 37746 plus 6304. Right. So the difference there is minus 74588. So it's 30538. That's the balance carried down. So this is what we currently owe our suppliers. Right. So we can see that from the trade payables control, we can click on we can open our accounting system. We can click on the general ledger. Then we go to trade payables control. We click it open. It's going to show us this. All right. These transactions, bank, this amount. It won't do the plus, right? Because it's us, we have to do that and make the entry. It will just show us these individual entries that we make. All right. Then we can see also we actually, and the system, the accounting system automatically calculates the balances. So you can see what's owing there. Right. So that's how you construct the trade payables control. You should be able also to construct the trade receivables control if you're given a little bit more information similar to this. It's all about principles. Which side does an account increase? Which side does it decrease? So, and you read the transactions, and then you determine whether there was an increase or decrease and which other account was affected. So it's going to take a little bit of practice, because we will learn in silos, right? You learn a single thing alone, you learn a single thing alone, but now combining them together is going to be a bit of a challenge if you do not have accounting background. But we hope that all this is going to be a lot of help to you. We wish you the very best in your studies, right? So if you continue subscribing to our YouTube channels, or to our tutorials if you want. Then we will help you to get a lot of knowledge on these things.